Hello and welcome to another video on US taxation. Today we are going to talk about the deductions that are going to get claimed by an individual post they have earned the income. In the previous chapter, we have learned the various heads of the income, like how the income needs to be reported for salary, investment income, rental income, and how income is earned for the capital gain. And we also understood the concept of income being earned by the self-employment. And we also understood that how these various income heads are being treated and what is the concept of the gross income. Now, from this chapter onwards, we are going to understand the deductions that can be claimed by an individual, which will then help them to derive the taxable income, and finally on which the tax will be applied. So today's chapter is to talk about the above the line deductions, wherein we are going to we will try to explain how the gross income is finally adjusted to arrive at the adjusted gross income, and then finally how this adjusted gross income is reflected in my form 1040. So we are going to discuss all this in this chapter. So let's move to the first slide and look at the agenda that we're going to cover today. Okay, so the key agenda that we're going to cover today is we'll understand the concept of above the line deduction. We'll understand what is the concept of the gross income and then how this above the line deduction are adjusted, and then we finally derive the adjusted gross income. What is the importance of above the line deductions and what are the examples or types of the above the line deduction? Then we'll try to understand each of this deduction in bit detail. For example, we'll try to understand student loan interest deduction, retirement contribution as adjustment, HSA contribution, self-employment related deduction, and then we'll also understand how the reporting of all these deductions are done so that they get reflected in form 1040. We'll understand the concept with the help of the detailed example and then final key takeaway slides. So let's move to the first slide. Okay, so when we talk about the above the line deduction, what does that mean? So above the line deduction are the specific expenses that taxpayer can subtract from their gross income to arrive at the adjusted gross income, which we normally called as AGI. These deductions are called above the line deduction because they are applied before calculating the AGI on the tax return. These deductions reduce the taxpayer taxable income regardless of whether taxpayer chooses the standard deduction or itemized deduction. So which means that this is independent of the standard deduction or the itemized deduction. So this is being claimed before the standard deduction or the itemized deduction, and this is independent. So this is even being claimed even if somebody is opting for standard deduction or somebody is opting for itemized deduction. What are the above the line deductions then? So above the line deductions are also known as the adjustments to the income because they adjust the taxpayer gross income before calculating the taxable income. So gross income minus above the line deduction is equal to the adjusted gross income. And this AGI is important figure because many tax benefits and deductions are based on the taxpayer AGI level. So which means that once we have derived the AGI, this AGI form the basis for claiming various tax credits and other deductions. And it is also helps to understand once we have the AGI, then a lot of deductions and other information is largely based upon the phased out methodology of AGI. So correct calculation of AGI is very, very important. Why they are called above the line? Because the terms come from the layout of the tax return. In the tax calculation process, taxpayer first determine the total income, which is the gross income. Then they subtract the adjustment to the income, which is the above the line deduction. This is called adjusted gross income once they deduct that. Because these deductions occur before the AGI calculation line on the tax return, they are called above the line deductions. What is the importance of the above the line deduction? That reduces the adjusted gross income, lower the overall taxable income, make the taxpayer eligible for the additional tax benefit, and can be claimed even when the standard deduction is used. So these deductions are therefore very, very valuable in the tax planning. So let's move to the next slide. Okay, so having understood the concept of above the line deduction, the next question comes then what is the difference between the gross income and the adjusted gross income? So this slide helps us to understand both of them distinctly, and then we have a table in the next slide which demonstrate the key differences between the gross income and the adjusted gross income. So understanding the difference between the gross income and adjusted gross income is essential in the US tax system because AGI serve as the starting point for calculating the taxable income and determine the eligibility for many deductions in the tax credits. So what is the gross income? Gross income refers to the total income received by the taxpayer before any deduction or adjustments are applied. Gross income may include the salary income, interest income, dividend income, self-employment income, rental income, capital income, gain income, and other miscellaneous income. Gross income represents the starting point. So which means that once an individual has earned a multiple set of the income, the first starting point before an individual can assess that how much tax he or she has to pay is the accumulation of all those various heads of the income. This is the specific logics for that particular head. Then the total calculation is treated as the gross income earned by the individual. The adjusted gross income is taxpayer gross income after subtracting the certain allowable adjustments. So once that gross income has been aggregated or calculated, the next step is to adjust and deduct the deductions which are there, and we'll talk about these deductions in detail, few of them in detail in the upcoming slides. When these deductions are deducted, the rest of the income is called the adjusted gross income because we have deducted the above the line deductions. So AGI is the key figure throughout the tax return because many tax benefits depend upon that. Adjusted gross income is important because it determines eligibility of the many tax credits. So we talked about that because tax credit depends on the AGI, and then the phasing out of the tax credit depends upon the AGI limit that is being there for separate categories, and then serves as a base for the calculating the taxable income, influences the limit for the several tax benefit, play a role in overall tax planning. So many tax provisions or phased out limits are based on the AGI level, and this is again subjected to the status of filing the return, whether return is being filing singly, jointly, whether as an individual or whether it is being filed as a separated individual. So whatever those case may be, those are getting impacted with the concept of AGI because the limits and the phase out limit is calculated at each of the return filing status along with the AGI that they are reporting. So we'll move to the next slide and see a comparative table between the gross income and the AGI. So this table speaks about the differences between the gross income and the adjusted gross income. And definition, gross income is total income from all the sources. Adjusted gross income is the income after adjustment. The purpose of the gross income is the starting point of the tax calculation, and adjusted gross income is basis for calculating the taxable income. Adjustments are no deductions are applied in the gross income, and then above the line deductions are the deductions that are applied to calculate the AGI. So we'll move to the next slide. Okay, so now we'll understand the importance of the above the line deduction. So first benefit is the reduced adjusted gross income. So one of the most important benefit for the above the line deduction is that they directly reduce the taxpayer AGI. Since many tax rules and benefits are basis the AGI, so reducing AGI can provide the additional tax advantage by reducing the taxable income and by also claiming the additional tax credits. So gross income minus above the line deductions is equal to the adjusted gross income, which lowers the overall tax liability. It is available to all the taxpayer. Unlike the itemized deduction, above the line deductions can be claimed even if the taxpayer uses the standard deduction. So which means that in the case of itemized deduction, either of them is applicable, whereby an SSC can claim either the standard deduction or the itemized deduction. But above the line deduction is available to all, irrespective of the fact whether that individual is claiming the itemized deduction or the standard deduction. So example, a taxpayer who chooses the standard deduction can still deduct the student loan interest, IRA contribution, and HSA contribution. Increase the eligibility for other tax benefits. So many tax credit deductions have income limit based on the AGI. By reducing the AGI above the line deduction, taxpayer may become eligible for the additional benefits such as the educational tax credit and the child tax credit and the retirement contribution credits. Thus, above the line deductions can unlock additional tax saving. It reduces the overall taxable income since AGI is used for the starting point for the calculating taxable income. Lowering the AGI will definitely have the cascading impact of lowering the taxable income and hence the consequential taxes. We'll move to the next slide and see rest of the benefits and the importance of above the line deductions. Okay, next benefit for the above the line deduction is support the important policy goals. So above the line deductions are often designed to encourage a certain financial behavior like contribution to the retirement, contribution to the education through student loan interest, HSA contribution, and so because these are some of the social securities and the benefits which is being given to the individual and the citizens, and hence any contribution to them will help them to reduce the AGI, and it encourages this contribution as well. So improve the tax planning opportunity and by reducing the tax liability, manage the AGI threshold and optimize the eligibility of the credit deduction. So some of the examples of above the line deductions are student loan interest reduction, contribution to the traditional individual retirement account, HSA contribution, deduction on half of the behalf of the self for half deduction for half of the self-employment taxes, self-employed health insurance deductions. So all these are deductions which is being claimed by the individual to derive the final AGI. So we'll move to the next slide. Okay, now we'll talk about the type of the above the line deduction and we'll talk about each of them in bit detail. So first is the educator expense. This is eligible to teachers and educators whereby teachers and educators may deduct certain unreimbursed classroom expenses. For example, classroom supplies, books and institutional material and the teaching equipment. These expenses must generally be directly related to the classroom. Second one is the student loan interest reduction, and the taxpayer who pay interest on the qualified student loan may deduct a portion of the interest paid during the year. So basically applies to the interest paid on the education loan subject to the income tax phased out and helps the reduce the common cost of the higher education. Traditional IRA contribution, the contribution made for the traditional individual retirement account, health saving contribution which is being done by the individual as well as the self-employed for their health saving, and this is something which are deductible and help to reduce the AGI. We'll move to the next slide then. Next is the self-employment tax deduction, whereby individual can claim 50% of their employment tax that they have paid. Then self-employment tax deduction, and finally alimony paid for certain agreements. So we have educator expense, support the classroom spending by teachers, student loan interest, reduces the cost of the education debt. Traditional IRA contribution increases the retirement saving. HSA contribution support the healthcare savings. Self-employment tax deduction reduces the tax burden for the self-employed individual, and then self-employed health insurance is deduct the healthcare premium paid by the self-employed individuals, and alimony paid is deduction of certain amount of divorce agreement. So we'll move to the next slide. Okay, so now we'll talk about each of the deduction separately. We'll talk about first the student loan interest deduction. So student loan interest deduction allows taxpayer to deduct the interest paid on the qualified student loan used for the higher education expenses. So this deduction helps to reduce the cost of education by lowering the taxpayer adjusted gross income. The student loan interest deduction is classified as above the line deduction, meaning that it can be claimed even if the taxpayer does not itemize the deduction. So maximum deduction limit is taxpayer can deduct up to $2,500 per year in student loan interest paid during the tax year. The deduction applies to only the interest payment and not to the principal payment. And if less than 2,500, then only the actual interest paid can be treated deductions, which means that actual interest paid or 2,500, whichever is less, is the deduction which is being eligible for student loan repayment. And this is only applicable on the interest portion of it. So qualified student loan is a loan taken solely to pay for the higher education expense. Eligible deduction expenses are tuition and fees, books and education supplies, rooms and the boards for the enrolled and the other necessary. So purpose of the loan should be the tuition and fees, books and education supplies, rooms and board for the enrolled students and other necessary expenses which are required to be incurred to make sure that the student is could able to manage this education. The loan must generally be taken for education as eligible in educational institution. And to qualify for student loan interest deduction, the taxpayer must meet the following condition. The taxpayer must legally oblige to repay the loan. The loan must have been used for the qualified education expense. The taxpayer cannot be claimed as a dependent on another person return income, and the taxpayer filing status cannot be married and filing separately. So these are the conditions which are the limits or limitations, I would say, specific limits or the conditions that are required to be adhered to while claiming the deduction for the interest on the home loan or student's loan. Sorry. So income phased out limit is the student loan interest deduction is subject to the income limitation. So lower income is full amount deductible. moderate income partial deduction, and higher income deduction phased out. So we have all these limits available. Lenders typically reports the amount of the interest paid during the year on through the form 1098E. This is the form in which the lender is going to report the information of the interest being paid. Taxpayer uses the information from this form and claim the deduction by completing the schedule 1. So this is the first deduction which is being available to an individual. We'll move to the next deduction then. Second is the retirement contribution as adjustment. So contribution made to certain retirement saving qualify for deduction, which is like contribution to traditional individual retirement account. Traditional IRA allows individual to contribute the fund toward the retirement and potentially deduct this contribution as their taxable income. So contribution makes are tax deductible. So investment earning grows and tax deferred. Whenever the maturity is there, then the tax has to be paid because the initial contribution was adjusted in the gross income. So contribution limit, the IRS sets the annual limit and how much individual can contribute. The contribution limits depend upon the age, annual income, and the participation in the employer-sponsored programs. In general, taxpayer can contribute up to the annual limit or either the earned income, whichever is lower. Individuals aged 50 or more may qualify for additional catch-up contribution. The ability to deduct the IRA contribution depends on certain factor. Full or partial deduction may be allowed depending upon the modified adjusted gross income, filing status, and the participation is an employee contribution retirement such as the Form 401k. So in nutshell, the contribution made by the individual to IRA is subject to the deduction. The amount which they contribute for the retirement plan is being adjusted from the gross income to derive at the adjusted gross income. And this is the contribution which is made by the employer, and because this is being deducted from the gross income at the time of maturity or when they receive the money, this is subject to the normal tax because this is the contribution which was adjusted when made through the gross income. So we'll move to the next slide and see the next deduction. Okay, next contribution is HSA contribution. So HSA contribution is a tax advantage saving account designed to help the individual to pay the qualified medical expenses. Deduction is available even if taxpayer does not deduction is available even if the taxpayer does not itemize deduction, making it a valuable tax benefit. And it has to be shown as the Schedule 1 and resulting AGI in the form 1040. So HS is a personal saving account and used to pay the qualified medical expenses available to the individual which are enrolled in the high deductible health plan. Funds covered used for the doctor visit and the medical treatment, prescription medicine, dental and the vision care, certain medical equipment and the supply. What is the HSA? An HSA is a personal saving account used to pay the qualified medical expenses available to individual enrolled in the high deductible health plan. Funds contributed to the account can be used for the doctor visit and medical treatment, prescription medication, dental and visit care, and the certain medical equipment and supplies. Contributions eligibility of the country requirements are the must be covered as the high deductible medical plan, cannot be enrolled in the Medicare, so which means that either they can be Medicare or that can be HDHP plan, cannot be claimed as a dependent on another person taxable income, and must have another health coverage that is not comparable with the HSA, must not have any other. So which means that there are certain conditions which are again allowed to HSA account. So which means that HSA contribution can be eligible for the deduction. It cannot be enrolled in Medicare first of all. Must be covered as the high deductible health plan and must not have any other coverage that is not compatible with HSA. So only taxpayer who meet the requirement are allowed to make the deduction on the HSA contribution. Tax advantage of HSA contribution that health saving account for a unique triple tax advantage. Contributions are tax deductible, investment earning grow tax free, withdrawal for qualified medical expenses are tax free because of these benefit HSA are considered one of the most important tax saving tools. So which means that any contribution which is being done in this is tax free. Tax free as in because the adjusted gross income is reduced. When you use that expenditure for your medical care or for the treatment, all these expenses are tax free, which means that you are basically creating a consortium for your own health. And then if you are not using it, then definitely it is earning an interest. So interest earning on that particular contribution is also tax free. So triple advantage, so which means that your AGI is getting reduced, you are earning income, on the contribution which you are making, which is also tax free. And then once you withdraw that, but once you use that amount post withdrawal from the HSA, then these are also tax free, because basically this is the expenses that you are going to incur for medical treatments. So this is the best saving or the best tax planning that can be done by an individual. So we'll move to the next slide. Okay. So another deduction that is being claimed from AGI is the self-employment related deduction. So US individual incur costs related to running their own businesses, and the deductions that are available to these individuals are deduction of the half of the self-employment tax. So 50% of the tax that they have paid is claim and deduction. We already have discussed this in the self-employment income scenario. Self-employment health insurance deduction. Self-employment individual will deduct the health insurance premium paid for themselves, their spouse, their dependents. This deduction helps them reduce the cost of the healthcare for individuals who do not receive the employer-sponsored insurance, and then the retirement contribution for self-employment individuals. Self-employment taxpayer may contribute to retirement benefits for the owners, such as the simplified employee pension and the solo retirement benefits. So, benefit of this employment action is that these reductions help them to reduce their AGI, lower the tax liability, encourage the retirement saving for the business owners, and then definitely help them to offset the healthcare cost for the self-employment individuals. So, we'll move to the next slide. Okay, now we will understand how we have to report all these deduction and then final how this will be reflected in my form 1040. So above the line deductions are also known as the adjustment to the income and are reported on the specific section. So we'll talk about that. So first step is to determine the gross income. The first step in the tax calculation process is to determine the total income, which is the gross income, which is the addition of the income earned through various heads like salary and the wages, interest income, dividend income, employment income, self-employment, and rental income, and the capital gain. So this total income forms the starting point for calculating the AGI. Step 2 is to determine all the eligible deduction, and then we total all this deduction. We'll have the AGI when we subtract this adjustment from our gross income. Report the adjustment on the schedule 1. So all the deductions need to be reported in the schedule 1 and part 2 of the adjustment income like student loan interest, IRA contribution, HSA contribution. This will be shown as in my schedule 1. Move to the next slide and see rest of the reporting mechanism. Okay. So we have understood the concept of schedule I. Then schedule step 4 is to transfer the total adjustment to the form 1040. So total adjustment calculated in schedule 1 then transferred to 1040, when we have shown the gross income, and then total adjustment is 7500, which is some of the various deduction that has been claimed by the individual. And adjusted AGI is shown as 72,500. So reporting flow is total income, calculate the gross income, report adjustment, total adjustment, and calculate the AGI. So this is how it is being normally shown. So we'll move to the next slide. Okay, now we'll talk about a detailed example and tries to understand that how the adjusted gross income is calculated. So David is an individual who earns income from the multiple sources, and we'll understand that how he is going to get the deduction, and then finally how it is going to be reported in form 1040. So step 1 is determine the gross income. So various sources of income are there, and then we calculate the gross income is $80,000. Step 2 is to identify the other deductions. So student loan interest, traditional area contribution, HSA contribution, half of the employment tax, which is 1,000, and this is the total deduction, which is there 9,000. It has to be reported in the schedule 1, and the deduction is reported in the part 2 adjustment to the income to the schedule 1. We'll move to the next slide and look at the rest of the example. So whatever is going to get deducted will be reported in the schedule 1. So total adjustment is 9,000. AGI is 80,000 minus 9,000, which is 71,000. This amount is reported in form 1040. And after determining the AGI, taxpayer may further reduce their income by applying the standard deduction or the itemized deduction, and then finally the qualified tax credit. So gross income minus above the line deduction is equal to AGI. AGI minus standard deduction and itemized deduction is the taxable income, and then we'll calculate the tax, and then finally we'll get the tax credit. So final tax payable is the tax minus the tax credits. This is how we're going to do the entire tax calculation for individuals. So we'll move to the final slide, which is the key takeaway slide, and let's understand what we have understood in this chapter. So what we have understood is that the above the line deductions they reduces the gross income, and then above the line deductions are available to all the taxpayers, and it is being made available even if the individual is claiming the standard deduction or the itemized deduction. AGI is critical tax figure because this is this lot of the benefits and tax credits are calculated because AGI phased out is one of the important criteria. And proper reporting of this is essential to make sure that information is reported properly in formal foods. So with this, we come to the end of the chapter. We'll move to the final closing slide and see what we are going to discuss in the next upcoming chapter. Okay, so what we have understood is that we have understood above the line deduction and how the various above the line deductions are calculated, what are various type of the above the line deduction, and how it is being made available to all the taxpayers. So with this, we come to the end of this chapter. In the next chapter, we are going to talk about the standard deduction versus the itemized deduction. We are going to look at all the information that can be claimed by an individual as a form of standard deduction and the choices given to the individual whether they can claim the standard deduction or the itemized deduction. These deductions are applied after AGI is determined and they further reduce the amount of income that is subject to the taxation. So understanding how these deductions work is essential because they directly affect the final taxable income and the total tax liability for the taxpayer. So with this, we'll come to the end of chapter. So we'll come up with a new chapter very soon. Until then, thank you, goodbye, and have a